Okay, so good morning, everyone. I'm Nisha Jaidas, and it is an absolute pleasure to welcome you all to this enlightening webinar about UAE corporate tax, organized by RDS Accounting and Bookkeeping. Now, many of you are already familiar with RDS, but for those of you who are new, let me share a bit about us. RDS was founded in the year 2017 here in Dubai, and we quickly expanded our reach to Bahrain in 2018, and we also set our footprint in India in 2022. Our spectrum of services include accounting, audit, VAT, corporate tax consultancy, feasibility studies, business valuation, business planning, operational support, and crucially, tax planning. We are much more than an accounting firm. In fact, we are more like partners to our clients. Through our specialized tax planning services, we help businesses navigate the tax regulation, maximize tax savings, and enhance financial efficiency. Our dynamic team of over 15 skilled, qualified, and also semi qualified chartered accountants work tirelessly to provide solutions that contribute to our clients' success stories. Today, we are excited to delve into mastering UAE corporate tax, your guide to regulations and smart compliance. This session is led by our esteemed senior tax advisory consultant, Ms. Ramita Pillai. Ms. Ramita is a member of the Institute of Chartered Accountants of India with a wealth of experience from her experience in KPMG, specifically in the field of indirect taxation. As a crucial member of our tax team, Ms. Ramita provides comprehensive advisory on UAE VAT law and also corporate taxation tax law, serving clients with a wide range of industries with her valuable insights and solution. Also joining us today is Ms. Dhanya, the director of RDS, who will also be addressing all your questions through our webinar. Please feel free to submit your questions in the chat window. Now, without much further ado, let's extend a warm welcome to Ms. Ramita Pillai. Over to you, Ms. Ramita.
First, let me extend a warm welcome to all the joinees here. It's a privilege to be addressing you and taking you through the UAE corporate tax provisions. UAE as a country has come far away from being a country with zero taxes. Now we have got VAT, and now we are almost entering corporate taxation. So in this webinar, we are intending not only to take you through the provisions of the CT Act, the Federal Decree 47, but we're also trying to make you aware of the areas which which will concern you in your day-to-day business activities. And we've also taken effort to incorporate the recent updates. So in this, in the most concise form, we'll be taking through the entire Act so that we get to know the gist of how to apply in our business activities. Now, let's begin from the beginning of the journey of UAE corporate tax. We were given a lot of time to get ourselves used to and understand that yes, we are going to enter a corporate tax regime. So the announcement came long before on 31st Jan 2022 when we announced that yes, CT is going to come. And then later in month of April, a public consultation document was issued. Now, this was a very welcome move because through this document, what was intended was that to collect the feedback of the industry players. Because UAE always wants to maintain its status as the most favorable country for this. And so in this consent document, we were the experts of the industry, we were asked to give the feedback as to how the CT law can be kept at par with other CT laws of other countries, and there will be more user-friendly, or more, rather not user, taxpayer-friendly. So after that, then yes, in 9 December came the Federal Decree was published, and from 1st June, it is just a couple of days away, we are going to enter the CT regime. Now, talking about the timelines, the Act says that the financial year beginning on or after 1st June 2023 is going to be your first year applicable for CT. So here we have taken a small tabular form wherein we are showing you the different financial years and what will be the first reporting year. So if you are having a financial year of July 22 to June 23, The first reporting year will be, yes, from July 23 because it is after June 23. And but in the same case, if it is from Jan to December, the CT applicable year will be only next year. That is 1st Jan 24 to 25. Similarly, with April, March also, the CT applicable financial, the first financial year wherein CT is applicable will be 1st April 24 to 25. And then after a period of 9 months is your return filing and payment date, which will come respectively. So you can see in the slide. Now, here one important thing to be noted is that although we know that the corporate tax is going to be applicable only from these mentioned years, there's a particular provision in the Act which is already effective. And that is known as the General Anti-Abuse Rules, commonly called as GAR. So the long story short is that this is applicable to see if the transactions made are having commercial substance. That means in a simple language, if you are doing any business restructuring, some new changes, it should be because of a valid business need. If the intention is purely to gain tax advantage, then the GAR portion will be applicable, and either the decision can be reversed by the authority and nullified, and can also lead to fines and penalties. So now in the screen you can see the gist of what the GAR rules intend. And the power given here is that the assessment authority, they can either disallow or allow the exemption reduction, whatever is claimed. They can recharacterize the nature of payment. So basically, every move that you take now, any change or any planning thing, it should be. Am I audible now? I think I suddenly lost it.
No. It's fine. It's fine. You're audible. Yes. Perfect.
So any tax decisions which you are any business decisions taken should have commercial substance. So now just to show it in an illustrative example, please note it is entirely fictional just to make the idea clear. So for instance, there's a company in UAE which is earning good profits every year. And from 1st April 23, the company is deciding to split and form two different entities, two different companies. And there is no compelling commercial reason for the change. Then the first year for the applicability of both entities will be 1st April. If you see, if without the split, the company was arriving at taxability, it would be liable to pay tax. You can see in the first column, company XYZ, it is liable to pay tax. But after the split, since both the companies are getting the basic exemption limit, it is coming as nil. So now this is a clear case where a change is being made with the sole intention of obtaining tax advantage. And here, GAR portions will be applicable. So as I told, it's just a very simple illustration to get the idea across. So now, this GAR rules are already applicable. This is applicable right from the date the CT law has been published. So the advice here is that any decision taken now should have commercial substance, should be backed by proper business need, and not solely gaining tax advantage. Yeah. So now looking at the framework of CT law, the law issued is fairly simple. It's at par with most of the corporate laws in other countries. You see, it has 20 chapters, which deals with definitions, taxables, free zone, a favorite topic, then with deductions and the calculation payments. It is encompassed in these 20 chapters. Now, the CT law will make more sense only if it is read together with the business decisions, the cabinet decisions, and the ministry notifications, which are being issued one by one. So now, as I told, we have tried to incorporate it in the slides as and when applicable. Now, let us begin with the corporate rate, the exempt people. Exemption is two types. One, people who are absolutely exempt, they don't need to apply to get the exemption. The other sector is the people who have to apply. So by the absolute exception is for the government entities, government control entities, the extractive and non-extractive business. Here, this is exempt because they are already under the purview of the emirate level taxation, and hence not the CT not applicable to them. Now, coming to the category of people who are exempt by application, is the qualifying investment fund, the qualifying public benefit entity. Now, regarding the qualifying public entity, decision has been issued, wherein entire list of who are the approved public benefit entity, that list has been issued. Then we have the approved public pension and the person wholly controlled by an exempt person. So these are the two categories who are exempt. Now, no, in one, I just missed out an important point. If you look at this, in the extractive and non-extractive business, this exemption is not applicable to the contractors, subcontractors, and suppliers. So unless and until it is your core business and you have the license, that this exemption is not applicable. So the contractors and all, they will be liable to CT. Now, taxable person category, UAE is following a residence and source-based income tax regime. So here, the taxability person first we can see from the angle of residence. So there are two categories, resident and non-resident. So taxable persons among residents are first, every jurisdictional person, basically legal person, including a free zone who is in UAE. So if you are in UAE and you are a company in UAE, you're a legal person in UAE, yes, you are taxable. Then comes the foreign juridical person. It is effectively managed and controlled in UAE. So if you have a foreign, it's a foreign company, but having an office which effectively managed and controlled UAE, yes, it is taxable. Now come to natural persons, individuals who are conducting business. So what is important to note here is if a natural person is deriving only salary income, it is not under the purview of CT. Whereas if he is conducting a business and getting business income, then yes, CT is applicable. And then any other person as may be specified by the cabinet decision yet to be notified. So these are the resident categories. And in non-resident, you have any permanent establishment in UAE. Now this permanent establishment we refer to as P. It's a whole new topic and we will be dealing it in detail in the coming slides. So if a non-resident has a permanent establishment, basically if he has an office, a fixed place of operation here, or a person who's wholly and solely for him, that also counts as a PE, then he is taxable for UAE city. Then also if a non-resident is driving UAE sourced income. Now UAE sourced income is also defined in detail. We are coming to it in next slides. And then if he has a nexus. Now this nexus is yet to be defined. Basically in common parlance, nexus means a relation. So maybe they are hinting at whether we have any income from related parties, but that is not yet clarified. So let's wait for the clarification. So right now we will deal with the PE and the UAE sourced income. Now the rate of corporate tax here, as we know, the basic exemption limit is being set at 3,75,000. So for a taxable income till 375,000, it is nil, and anything exceeding the portion over and above 375 will be taxed at 9%. Talking about qualifying free zones, for every qualifying income, it is 0%, but for the non-qualifying income, it is 9%. Now, the free zone, as I earlier mentioned, is a whole new topic on its own, and the detailed decision on it is not yet issued. So we do not know the definition of qualifying income, but yes, what we are aware is that it should be a qualifying business zone and carrying on the proper approved business. So in these cases, if it's a qualified income coming under qualified income category, it is 0%. Otherwise, it is 9%. Now, what is important to note here is that for any unincorporated partnership firms which are not incorporated, they will not be seen as one person. It will be like a physically transparent. So the partnership will not be taken as one entity, but the partners will be taxed individually. So it is like a flow through. It is physically transparent in the case of unincorporated partnership firms. All right, and now as I told you earlier, it is a residence and source based. So for every resident judicial person, what income is taxable? Basically, everything is taxable. The whole worldwide income, what he earns, the income earned in UAE and outside UAE is taxable. Any business income, capital gain is taxable. So for a resident, a juridical person, a legal person who's resident in UAE, worldwide income is taxable. Now, sorry. Now, sorry, there was a technical glitch. Now, for a resident individual, as we mentioned earlier, only and only if he is getting income from business, then it is taxable. Salary income, the real estate income, investment income is outside the scope of corporate tax. And now for a non-resident, income coming from the PE in a UAE, that is from the office or main agent here, is taxable. A UAE sourced income not imposed. So if you're getting income from a UAE source, maybe a property, right, that also is taxable. And again, income attributed to nexus. So indeed, this is the CT base. These are the incomes which will be taxable in the respective hands of the resident company, resident individual, and a non-resident. Now, there's a cabinet decision issued which clarifies that if a natural person is conducting business and the total turnover does not exceed 1 million, then they do not register. So only if the business income is above 1 million, then they have to register and they come under the CT purview. Right? So now, as I mentioned earlier, we spoke about UAE sourced income. So what is UAE sourced income? As the name itself indicates, UAE source income. Any income which has a source in UAE. So if it is derived from a resident person, so if you're getting the income from a person who is resident in UAE, it is UAE source income. If you're getting an income from a non-resident person and it is attributed to his PE, that is the office in UAE, then again it is a source from UAE, so it is UAE source income. And then from any activity or sales, anything performed in UAE, maybe the asset is located in UAE, the capital invested in UAE. Basically, if the source is in UAE, that is the income sourced from UAE. I can give a non-exhaustive list. It is not like this is the only items, but a few items are when you get income from sale of goods, provision of service, use or right to use of property, intellectual tangible, interest income, insurance. So these are all the examples of sourced. Now what I've been saying for so time, P, permanent establishment of a non-resident. So here the concept is if a non-resident has a place of business, a fixed, not temporary, if he has a fixed place of business or a person who's working on his behalf mutually, only and only for him, then it constitutes as having a base in UAE, and that is called permanent establishment. Yeah, so you have it can be in three types. One is a fixed place, a proper place. So it can be a place where decisions are taken, where there is a managerial office. If that place is in UAE, then yes, there is a PE in UAE. And then next is a dependency test. So if the non-resident does not have any office per se, but if he has an agent here who wholly and solely mutually exclusively works for the non-resident and has the authority to conduct business on behalf of non-resident and conclude contracts on behalf of non-resident, then he is a dependent agent, and through him a PE is formed. So through him, the non-resident has a PE in UAE. And then the nexus, as I discussed earlier, nexus is not properly defined. But again, through a nexus, also PE can be formed. The details are yet to be issued. So now what is important here is that no PE will be created if the agent is independent agent. That is, if the agent is carrying out or helping the non-resident as an agent in the normal course of business, and the non-resident is just one of his clients. In the sense, he works for many other clients and not just mutually exclusively only for the non-resident, then it is independent agent and then no PE is created. All right, now I can list a few specific inclusions, like where you have a place of decision, a branch, a factory, a workshop, and any place which in a site office, provided it lasts more than 6 months. As we mentioned, the point noted here is it should be permanent, not a temporary structure. And what was a welcome decision which was coming in the ministration is that a presence of an employee, just because an employee is here for some temporary reason or unavoidable reason, that does not create a PE. This was one confusion where if in case for a certain amount of time, employee is here for some reason he cannot travel, will that constitute a PE? That is being clarified here, that mere presence will not result in a PE, where it is due to temporary situation and where the employees engage in a non-core income, not the main activity, but the auxiliary, and the non-resident is not deriving any UAE source income, then it does not result in a PE. Again, these are the few examples which does not constitute a permanent establishment, hence will not lead to taxability. That is, if a non-resident just has a office wherein it is used for storing, displaying, or delivering of goods, or keeping a stock of goods, or purchasing goods and collecting information for the non-resident, that is basically conducting activity of a proprietary nature. In these cases, then it is not considered a PE. Yeah, I forgot to mention. So please feel free to ask your queries in the question in the board in the chat, and when it was the end, we will be addressing it. Yeah. So now come to our main topic: the qualifying free zones. Free zones is a hot topic, and as I mentioned, we are yet awaiting the detailed decision regarding what are the applicability and what are the definitions. So right now, what is available to us is that a free zone should meet all the conditions to be a qualifying free zone. And only if you're a qualifying free zone, you get the 0% benefit. So what are the conditions? One is you must maintain adequate substance. Adequate substance means it must be a company which actually there is a need for a company. It should have substance, not merely a sham company, not mere a name for sake company. It should have adequate substance in UAE, proper transaction business in UAE. It should derive qualifying income. Qualifying income is yet to be defined, so we need to know. And then the third condition is it should not elect to be subject to corporate tax, because there is an option available for the free zones that they call for the qualifying free zones, that if they want, they can opt to be taxed as normal category, come under the basic exemption limit and of 375, and above that pay 9%. So they can choose to come under the corporate tax purview. And so if he has to get the 0% benefit, he should not choose to come under CT. Another option is the condition is he should the free qualifying free zone should comply with the arm's length principle and any other condition as may be prescribed by the authorities. A failure to meet any one of the conditions, please note all these conditions are cumulative. If any one is not met, the free zone will not qualify as a qualifying free zone and hence will not get the benefit. Now, the qualifying free zones have a few limitations also. They cannot be member of the tax group. They cannot transfer or offset losses from related parties, and they're not eligible for the small business relief. And another important thing which has been notified in the latest issued decision is that qualifying free zone, irrespective of the turnover threshold, they have to prepare and maintain audited financial statements. So now henceforth, a proper booking system, it has to be audited and the financial statements have to be maintained by a qualifying free zone. Now, let us move forward as to how to compute the taxable income. The taxable income, as we know, CT is on not on the revenue, on the profit, and this accounting profit will have to go through various adjustments to arrive at the income which is to be which is liable for CT. So you have the accounting income which will arrive in the normal process, and from that the following items should be deducted. One is the unrealized gain or loss. Now this happens when we are following an accrual based system, and there is well, in simple words, if there is a gain or loss which has not actually been realized. And for example, if you have an asset which is stated in foreign currency, because of a change in rate, the value may fluctuate. So the unrealized gain or loss. Would well be later. Then the other one which has to be deducted is exempt income. As we know, exempt income is not liable to tax, so it will be deducted. Then you have a set of deductions and non-deductibles among the expenses which we incur. Then the reliefs is offered. Then you have the any income which is specific to be deleted. So from the accounting income which we arrive, we have to do a few adjustments to arrive at the taxable income. Now here, what you can see is that what the new decisions come with that financial statements have to be prepared as per IFRS. And where the revenue does not exceed 50 million, they have to follow IFRS for SMEs. So basically, the applicable accounting standards for UAE has been defined as IFRS, and hence, if you are preparing the books of accounts, you have to follow this IFRS. And also, but there's few people who are for the taxable people whose revenue does not exceed 3 million, they can still choose to follow the cash base of accounting. It is only for people, for the taxable people whose revenue does not exceed 3 million. Others, they have to follow IFRS. Yeah. And now earlier we mentioned that the qualifying free zone has to maintain audited financial statements. The same condition applies for any taxable person who derives revenue more than 50 million. Yeah. These are two categories who have now been explicitly told to maintain audited books of accounts. Now now let us deal with each and every adjustment to the taxable income, the exempt income. A few incomes have been specifically stated as being exempt. One is the dividend from UAE entity, the dividend from foreign entity as per participating interest. Now, this participating interest is another whole new chapter by itself. We'll be coming to it in the later slides. Then you have the income of non-resident operating aircraft and ship national transport, income from foreign permanent establishment subject to tax outside UAE, and other income. So here what you can notice, the common factor is that if any income has already been subject to tax, maybe here or outside, it need not be taxed again. It's a simple principle to avoid double taxation. So if you see dividend, it is not profit, it is a share of profit after tax, right? So when I get the share of profit which is already tax deducted, I need not pay tax on it again. So the same policy is followed in all the incomes. You can see dividend from foreign entity because the tax will be deducted outside. So these are all the exempt income which is listed. Now, as I mentioned, let us move to the participation interest. Now, what is participation interest? Participation interest basically means if you have a kind of a ownership of control in the investee company. So here it is defined to be 5% or greater ownership interest in the shares or capital of a legal person. So if I have 5% or more ownership interest in the shares of a legal person, then I am said to have participation interest in that. And then, but the conditions to be followed are, yes, the holding for the share should be for at least 12 months. I should hold, and I have the intention to hold for 12 months at least. Then the tax rate of the investee company is not less than 9% corporate taxes with the UAE. And then as a holder of participation interest, I have the right to receive not less than 5% of profit. So I receive more than that. And the investee company, the assets are not more than 50% of them are of exempt nature. Basically, at least not more than 50 nature should be ones which are not liable for tax. As I told you, the whole principle here is that the income which comes to me, if it has to be exempt, it has to be taxed, like for the dividend or the share. So if the entire set, the assets of the company is the majority portion something which is not liable to tax, then I cannot get the benefit. Then I have to be the tax. Yeah. So in these four cases is how we arrive at the participation exemption. So if I'm getting these income from a company wherein I have a 5% or greater ownership, then that is exempt. So talking about small business relief, it is applicable for the companies whose revenue does not exceed 3 million. Now, this is kind of a encouraging measure introduced. It's not for a long term because this relief will be applicable only from on or after June 23 and will end before 31st December 2026. So for a rough period of 3 years, this relief is given for the small business. But yes, again, qualifying free zone, these people are always under the radar, the qualifying free zone pieces. They have a lot of restrictions. So same thing, this relief cannot to be used or benefit cannot be sought by the free qualifying free zone people. And also if the company, the taxable person is a member of a MNC. These two categories, they are not eligible for the small business relief. Also, if you are obtaining this relief by by claiming to have no taxable income, then the losses you incur in these periods or the interest expense you accumulate these periods cannot be carried forward. Rightly so, if you're not paying tax, then there's no reason why the loss should be allowed to carry forward, right? So, small business relief is a measure extended as a as a boost for the small businesses. Now, coming about the deductible expenditure. As I mentioned in the accounting, when you arrive at the accounting profit, we knew what has to be the income which has to be removed. Now we discussed. Now about the expenses. As a business, yes, you will incur different expenses, but not everything can be deducted. So here there is a strict no deduction allowed for any income expenditure which is not incurred for a taxable business, which is not related to the business for which a tax is being paid, and any expenditure incurred for deriving exempt income, because if the income is not taxable, there is no point in claiming the exemption. Also, any losses not connected with the arising out of the taxable person's business, and any other business can be specified. And also, if there's any income which is partly used for the business and partly not, then you have to follow the proportion here. Now, this is where the importance of bookkeeping and properly classifying expenses comes into. And I request our director, Ms. Dhanya, to give more insight on the importance of bookkeeping in the current scenario of corporate tax.
So, thanks, Ramita. As we all know, accounting plays an important role when it comes to tax planning and compliance. So we can look at it in 5 different ways. The first one being the maximizing the deductions. So for this, first you have to identify the expenses, categorize them and record it to claim all the, to maximize, we will be end up paying the less corporate tax. So that is the first point. Then compliance with the tax regulation. We need to maintain the proper books of account in order to generate our financial reports, where it shows the profit and loss account, balance sheet, and the cash flow. So as we all know, without a proper books of accounts, we cannot prepare all this. And without this, we will end up paying fines or penalties when they ask for any financial reports, when like a government can anytime they can ask for the financial reports. So without proper book accounting and bookkeeping, we cannot do this. The third point is tax planning and forecasting. So the important thing is if you have a proper books of accounts in place, you can plan your taxes in advance, like how much will be the amount payable in the coming years. So you can manage your expenses. So those things can be done if you have a proper books of accounts. The fourth point being the managing cash flow. Whether the corporate tax is there or not, managing cash flow is an important thing. So for that, we need a proper accounting. Without accounting, we won't be able to anticipate like our inflows and outflows, which in turn, like we cannot calculate the working capital requirements. And if once that corporate tax starts, then we cannot manage the tax amount which is payable in the future. So for cash flow, we need a proper accounting in place. And the fifth point being the collaboration and reporting. So as you all know that we need to maintain an accounting to prepare the financial reports, which we have to submit to our stakeholders. So proper reporting means it will show like a transparency of a company, that shows a transparency of a company. So if all these accounting and bookkeeping are in place, we can maintain like we can pay the taxes on time, like we can calculate the taxes and compliance. We can also follow the compliance as well. Yeah. So over to Ramita.
So thank you. Yeah. So now this again, just reiterating the importance of bookkeeping. It is no longer going to be enough of having an Excel sheet wherein, okay, I know what are my income, I know my expenses. That will not work. You need to convince the third party. We need to convince authority. So hence, bookkeeping, proper classification of expenses is of utmost importance. Yeah. Now coming to the next slide, wherein we are dealing with the interest expenditure and entertainment expenditure. So here, if you are having any interest expenses, we are talking about net interest expenditure here. Net means the income you have received from interest and the interest as per expense. So when you net it off, the proper expense remaining is the net interest expenditure. Now you cannot go and claim the entire lot in one financial year. That is said, no. The rule coming here is that we deductible up to 30% of the EBITDA. Now that is something which we have been hearing in other countries, not here. So EBITDA is the earnings before interest, taxes, depreciation, and amortization. So basically, the main income, whatever the cash, whatever. So 30% of EBITDA is what will be allowed to be deducted in one financial year, And the rest, don't worry, it can be carried forward. It is not that you cannot claim, it will be carried forward. And for subsequent 10 tax periods. Yes. So the entire lot will not be allowed in 1 year. You have to claim 30% only, and next goes to the next year. And there's also one clause that says that if your net interest expenditure, net means, as I mentioned, the income and then the expense minus income, if that is within the limit, then this 30% is not applicable for you. Now, what is the limit is yet to be notified. We can wait for that. But yes, there is a small ray of hope, which means, so if our net interest expense is not a big amount, maybe we can claim it in that year itself. And also, there's a specific interest deduction limitation rule for financial assistance between related parties. Now, if you have a related party, another entity which is related to you, then obviously there will be, we will help each other, maybe as loans, financial, and then you can claim an interest, like I have to, the interest is expenses there. You cannot claim any income or any expense which you want to show, as a legitimate expense because you're a related party. So since you're a related party, you come automatically under the purview of the transfer pricing and the arm's length. So any expense which is incurred, even if it's interest expense, it has to be at par with the market value, yeah, market rate rather. So now talking about the entertainment expenditure, this deals with the expenses which are incurred for entertainment, amusement, or recreation expenditure. Also, we are the expenses we incur in entertaining the customers, shareholders, suppliers, business partners, like we giving a meal or accommodation, providing helping in transportation, the admission fees, the facilities. So these are the expenses we normally incur. Yeah, the entire thing is not allowed. 50% of that will be given as deductible, and the other 50% is not carried forward. It is properly disallowed. Yeah, but then along with the Corporate Tax Act law, one more corporate tax guide has been issued recently, if you're aware, to give more details about the CT law issued. And in the guide, there's a clarification which says that if this entertainment expenditure is incurred for staff, employees, then this limitation does not apply. But what is important here is that it is not there in the act; it's come in the guide. And any for discrepancy or any mismatch, the law will be upheld. So we're not clear as to how much this is applicable. But yes, there is again a ray of hope, which is that if it is for the staff, it should be allowed. Now here is a set of the non-deductible expenditures, which is categorically, specifically said you cannot deduct from the accounting profit. The donations, grants, and gifts made. Yes, here there is a clarification comes. If donations, grants, and gifts are made to a qualifying public entity, benefit entity, then it is allowed. Otherwise, no. Then you have any fines and penalties, not allowed. If you pay any bribe or any illicit payments, definitely not allowed. The dividends, profit distributions, the corporate tax which you're paying, then the input VAT which is recoverable under UAE VAT, not allowed to be claimed here. And these are the expenses. Basically, if you see, these are the 9 categories which are allowed explicitly. Now coming to the main important topic of transfer pricing. Now this is a very hot topic in other countries. Here it is entering, but right now it is taking baby steps. So here what is important to us will be transfer pricing and the arm's length principle. So arm's length principle, let's not go to definition. Basically, it means that when you are dealing with a related party, maybe you have the share, you have the ownership interest, you have the control of the person. If you're a related party, any transaction, it should be at par with what would have happened if I deal with a totally stranger or a third party. The prices or the transaction should be at par. So that's what the arm's length principle means. That is, the results should be consistent with the results if the transaction was carried out by non-related persons. Now there are methods to arrive at it. The names are quite long, but not for us to get scared now. There's a comparable uncontrolled price method, the transaction net margin method, cost plus method, resale price, transaction profit method. And this transfer pricing also applies not only for the legal entity, but also the connected person. So if I'm an entity and the director or the officer of my entity, he is a connected person. So even the payments I make to the connected person, maybe in terms of salary or any benefit, it also has to correspond to the market value. Yes. Now, why did I say we don't have to worry about the methods? Because the transfer applicability is being declared. We have a notification now, and there's a limit set. So we'll come to that. And before that, let me show you in again, it's a fictional illustration, very core basic, just to get the idea communicated. So if you can see in the first example, A, if there is a company XYZ is in UAE, it has a corporate tax of 9%. You have another company in ABC name, and it's in Cayman Islands. Cayman Islands right now is having 0%. Okay, so if there is a transaction happening of service providing, wherein services are provided by ABC to us, and the company in UAE is giving a fee of 20 million dirham. So, and these are related entities. So, what is actually happening here is that there is a shifting of profit, right? Because if you see, both of them are related entities. So, profit, if I earn or the other person earns, it is profit really for us. So, what is happening is the income here or the amount is being shifted to that to a tax neutral entity. That is not allowed. So this will be coming under the purview of transfer pricing. It will be seen that if the service is provided, what is the market value? Now, yes, the market will be arrived by the following method, by the earlier discussed methods, but I'm just telling you the idea here. So I'm saying, so if the transaction, the market value is only 10 million, but you have paid 20 million, the remaining 10 will be disallowed, right? So basically, only the actual value of the service will be allowed. Just because it's a related party, you want to pay more, you can pay, but it will not be allowed. Yeah. Same thing in the case of connected persons. You have a company in UAE, there's a sales director or any post, and the salary being paid is 3 million, maybe. But if you see the standard rate prevailing or standard is 1.5 or any amount. So the excess paid will be disallowed because it has to be at arm's length. So the principle to remember here is the arm's length valuation. Whenever you're dealing with a related party or a connected person, the transaction should be at arm's length. As long as it's an arm's length, there's no issue, there's no disallowance, nothing, because it's just like a third person. It's only when it doesn't match the arm's length pricing, then the deduction and the revaluation will be applicable. Yes. Now, transfer price documentation. So why did I say we don't have to worry? Like not everyone has to worry. In fact, it is the transfer pricing documentation and the details of maintaining everything is applicable only if it's a M&E group company and it has the group revenue of 3,150,000 dirhams, right? More or more. If it is more than 350 million dirham, then you are coming entirely under the transfer price and documentation regime. You have to maintain documents, that is the master file and the local file. Yes, and if it's an individual, not a group company, but a normal taxable person, if your revenue is 200 million dirham, then yes, even then you are under the transfer pricing purview. You have to maintain records, the master file, local file, and the arm's length, everything is applicable. So if you see the forms coming in transfer pricing, one is disclosure form, then is a master file, then the local file. So disclosure form will be given along with should be given along with the return, which has information about transactions and related parties. A master file basically will have a high level overview of the group's global operations, the nature of business, etc. And the local file will have the details which supplement the master file, right? The specific transactions, the specific method used, etc. So now coming to another deduction is a tax loss relief. So basically, if you have a tax loss in a year, you can claim that. But again, entire thing is not allowed. 70% you can claim 70. The loss that can be claimed, it should not exceed 75% of taxable income of that period. So if you have a taxable income, up to 75% of that, you arrive at the value, and that amount of loss you can claim. The remaining will be carried forward. There is no limit set; it can be carried forward to unlimited period. But for a particular period, you cannot claim the entire loss. You have to first arrive at the amount which is equal to 75% of the taxable income, and a loss equal to that can be claimed. Now, not every loss can carry forward. If it's a loss which is prior to commencement of the corporate tax or before you became liable to corporate tax, or if it's a loss from exempt activities, then it is not allowable. So, and as I mentioned, it can be carried forward and it can be set up in the future income. This carry forward is allowed provided the same persons or a person continuously own at least 50% of the ownership interest. The company, there's no massive big change, and at least 50% still continue to be held, then this tax loss carry forward and deduction can be claimed. Yeah. Now, another important concept is of tax group. Excuse me. Am I audible now? Yeah. So in tax group, the funda here is that if a person, excuse me, I just have water. So sorry for this health issue. Yeah, sorry for this health glitch. So coming to tax group, if I am a, oh god, it's still there. Again, sorry. So if it's a company and I own at least 95% of share capital or 95% of voting rights or profits are held by the parent company, then that parent company can form a group with the individual companies. This tax group has many administrative or compliance level benefits because you have to file only one return. The intergroup the intergroup transactions can be nullified and not accounted for. But the catch here is that if you look at exempt companies or qualifying free zone cannot become the subsidiaries. So I'll show you in a chart. The chart is later. Yeah. You see the tax group. If I am a parent company, ABC company, and it's in mainland, and there are three different companies. You have AB company, BA company, CD company. Now AB, the parent company has 96% of shareholding in AB, 95 in BA, and 98 in CD, and also has ownership in qualifying free zone company. Now, a tax group can be formed only by ABC company, AB company, and BA company because they are in mainland and they are taxable persons. If you look at CD, since it's an exempt person, no matter how much is the person ownership, it cannot be a member of the tax group. Similar the case with the qualifying free zone, it cannot be a member of tax group. So this group, this is how the tax group is done. And when you form a tax group, they can file single return and that has benefits. But the catch here is that the tax amount arrived will differ. So if you look at the table, individually when the companies apply the exemption limit, the tax is coming as lesser. But when you put a tax group, since you can claim only once the limit, the tax is high. That is a catch here. Now again, there's a transfer of loss relief. I think we are running short of time, so I'll better rush. Please feel free to ask any queries and we will reach out to you. We have the email. So if you have any queries wherein you feel I'm forced to rush, please raise the question and we will get back to you in a detailed answer. Fully happy to respond. Yeah, so now talking about transfer of tax losses. Same thing, if there are two parties, if they are related party and they have 75% in each other, then tax loss can be transferred. So let's not get into that because let's not go big and have a tax loss, right? Now, this is another new concept, foreign tax credit. Basically, if you have an income wherein you have paid tax in foreign land, and that can be claimed as credit here. So the entire working is detailed here. So when you arrive at the CT payable, you have another working to work out the foreign tax credit that is described here, and that portion can be claimed as credit. Yes. Now the tax compliance procedures, yes, you have to register yourself within 9 months from the end of the financial year. You have the returns, you must make the tax payment, then the assessment will come. They will check whether what you have done is right, and if not, then the fines and the penalties may come. And the most important thing note here is we need to keep records for minimum of 7 years following the end of tax period. Because to help, again, as I said, to help in assessment and the scrutiny, every record, be it invoices or the books, everything has to maintain for at least 7 years. Okay, so we have reached the end. I'm so sorry for the health issue I had, but I hope I was able to take you through all the provisions. Yeah, now let us take a few questions. Yeah, Danya?
Yeah, so we have one very, he's asking, I have one query that what is the difference between corporate and legal person and how it will affect the corporate in future?
Well, registration is now open. If you know the technical part or the field part is yet not aware, not fully clear. Right now, what is open is the registration for the individual companies. What I know, even group is not allowed. So individually, you have to register. For a natural person, procedure should be the same, as long as, because as I mentioned, a natural person gets the benefit of a natural person if he is not doing business. If he is doing business and gaining business income, it is at par with the other legal entities. So it should be similar only. But again, the practical form differences we need to wait and see. Okay, so, I think there are a lot of questions, but we are terribly short of time. But please be rest assured, we will be reaching out to you individually in the mail and we'll be answering to you. If you have any further queries, please feel free to reach out to us. Yes, and thank you so much.
Thank you, Ramita. That was an insightful presentation, and huge thanks to each and every one of you for your participation and engagement. Uh, since we are running short of time, please feel free to reach out to us. We are just a WhatsApp message or an email or just a call away. Also, if anybody requires any assistance in tax planning or need support to grow your business with our specialized services, please do get in touch with us. And rest assured, all the queries which have been raised today will be addressed to. So once again, thank you so much, everyone. Thanks a lot. Thank you so much. Yeah.
Thank you.
Tanya, would you any last words for our participants?
I hope she has covered almost all the regulations on the corporate tax. And if you have any questions, please feel free to contact us. And thank you for attending and thank you for taking your time, like almost 1 hour. Thank you so much.
Thanks, everyone. Thank you.